Okay, let's unpack this unusual earnings situation. We're diving deep into Bridgeline Digital's fiscal Q4 2025 results.
Yeah, this one is a real head-scratcher.
It is. It's a story of whiplash, amazing operational metrics on one side, fighting tooth and nail against, these sticky legacy issues, and flat overall revenue.
It was a classic tale of two companies earnings call. Management was shouting from the rooftops about transformation, product speed, and efficiency gains.
But the stock market just wasn't listening.
Exactly. The market was completely focused on the headline numbers.
And that's precisely where you see the split. We saw a great after-hours pop, over 5%, only to watch that enthusiasm just evaporate. It was gone by the next trading day.
Yep, close in the red.
So our mission today is to cut through that noise. Is this a powerful, high-growth sauce engine that's just trapped inside a small company with legacy baggage? Or is this simply a microcap that doesn't have the financial runway, the cash, to execute its vision?
Well, we have to start with the hard numbers, because this is really where that skeptical view comes from.
Okay, let's do it.
On the bottom line, Bridgeline delivered a pretty welcome surprise. They reported non-GAAP EPS at -3 cents.
And the consensus was what?
Zacks consensus was -6 cents. So that's a 50% beat. That's the kind of number that usually sends a stock flying.
Usually, yeah. So they controlled costs better than expected, but it was still a loss. And the revenue picture, that was the real anchor, right?
Precisely. Total revenue for the quarter was $3.9 million.
Which is just flat year over year.
Completely flat. And, it technically squeaked past the consensus estimate, but the market only saw zero growth. Flat revenue is just a hard sell for a tech stock.
Right. And if we look at profitability, the picture gets a little blurrier.
It does. The margins showed some stress, which definitely worried the street. Overall, gross margin declined a bit to 66%.
Down from 69% the year before.
Right. Which suggests that the legacy products, or maybe it's the mix shift pressure, is eating into that higher margin subscription revenue.
So the net loss was still there?
Yep. A net loss of $7.4 million for the quarter. And adjusted EBITDA was also negative at around -$169,000.
So the market red is undeniable. It's, hey, you controlled costs, great EPS beat, but your revenue isn't moving, you're still losing money, and margins are slipping. We're not convinced.
It's a textbook case of operational success being penalized by financial inertia. Which, brings us to the core of the bull case. This is everything management wanted us to focus on.
The pivot.
The pivot. They're trying to get everyone to look away from that consolidated flat number and just emphasize the growth in their core products, which is all about the HawkSearch suite.
And that part of the business is actually growing.
It is. They said annual recurring revenue, or ARR, for those core products is now at $8.9 million.
And the velocity in that core segment is really remarkable. This is the part of the call that makes the flat total revenue feel almost tragic.
Well, let's look at the metrics. The core products grew 16% year over year. That's solid sauce growth.
Okay, 16% is good.
But the metrics that really stand out are about customer health and retention. Net revenue retention, or NRR, was outstanding at 117%.
Wait a minute. NRR is a huge metric for sauce. Can you just walk us through what 117% actually signals? How rare is that?
It's gold standard. It means net of any customer losses, your existing customer base is spending 17% more with you year after year.
So they're buying more seats, more features.
Exactly. It confirms the product is super sticky and incredibly valuable to the people using it. They're also saying churn for HawkSearch customers is less than 4%.
But hold on. If NRR is 117% and the core business is growing 16%, but the total company is flat, doesn't that imply the drag from the legacy business is much, much worse than they're letting on?
That is precisely the question the market is wrestling with. The math suggests the legacy revenue is evaporating very quickly.
Which puts even more pressure on them to execute.
Right. And that's why the second set of operational metrics is so important. Sales efficiency.
They talked about dramatically shortening their sales cycle. How much better did they get?
It's a massive gain. The average sales cycle was almost cut in half. It dropped from 160 days in fiscal 24 to just 92 days in 25.
Wow, 92 days.
And that includes everything, wins, losses, all of it. So decisions are just being made much, much faster.
That's a huge cut. It really sounds like their B2B search product is less of a nice to have and more of an emergency aspirin for these companies.
It does. And they're not just selling faster, they're selling bigger deals.
Right. The average ARR per sale
Grew 35%. jumped from about $18,500 to $25,000. So customers are buying the whole suite right away.
Which is just a textbook example of finding your product market fit.
It is, and this momentum really sets up their future. Management highlighted that their sales pipeline going into fiscal 26 is 65% larger.
So if you combine a 65% bigger pipeline with a 92-day sales cycle and bigger deals, that should translate into ARR acceleration very quickly.
It should. And to back all this up, they pointed to external validation. They got a #1 ranking in Gartner's Critical Capabilities report, specifically for the B2B search use case.
That's huge for a small company. Gartner's name carries a lot of weight.
A tremendous amount of weight.
Yeah.
And that B2B focus is deeply tied to AI. The product cadence they talked about was all about using AI to handle complex, messy enterprise data.
So what are the actual AI features that are driving that 117% NRR?
Well, they detailed a few. First was something called Agentic AI, which is like a smart data lake and analytics assistant for their customers.
Okay.
But the more cutting edge one is Smart, Search Smart Response. This uses generative AI for what they call conversational commerce.
Conversational commerce. So the search engine doesn't just give you a list of links, it actually answers complex questions.
Exactly. They gave a real world example of a customer called TechLock. They sell hardscaping products. They added Smart Search to analyze huge technical documents. So now a contractor can ask, what's the shear strength of this paver at minus 20 degrees? And the system gives a direct, intelligent answer. It moves them right to a purchase.
I see. That's functionality that directly translates into revenue for their customers. That completely justifies the higher deal size.
And they also proved they can handle massive scale. The expansion with their longtime customer, Do It Best, was impressive.
What are they doing there?
They're using HawkSearch to power search for 170,000 products, with real-time inventory and pricing for over 3,000 locations.
So it's mission critical stuff at a huge enterprise scale.
Exactly.
Okay, so we have undeniable operational success in the core business, but the market's still stuck on that legacy drag. Let's talk about the strategic catalysts that are supposed to fix this.
Right. Management addressed the mix shift problem head on. They stated that the drag from legacy products is expected to end in 2026.
That's a pretty bold statement.
It is. The explicit goal is to get HawkSearch to be, and I quote, meaningfully greater than 60% of total revenue.
To hit that number, they can't just rely on direct sales. They need to expand their market. This is where the new platform partnerships come in, right?
Absolutely. Two key partners were highlighted. First, an integration with Unilog. They focus on B2B distribution and manufacturing, which is a perfect niche for Bridgeline.
And the second one is much bigger.
Much bigger. It's getting HawkSearch onto the Salesforce AppExchange.
The Salesforce AppExchange is a giant distribution engine. For a microcap, getting on there is transformative. Why is that?
It fundamentally changes their customer acquisition cost. Instead of cold calling, they get immediate passive access to tens of thousands of existing Salesforce customers who are already looking for this kind of software.
And management said revenue from these channels is just starting to come in.
Just starting. They expect it to accelerate significantly in fiscal 26.
But, accelerating growth and marketing those partnerships costs money.
Yeah.
A lot of money.
It does. And they announced a pretty significant commitment. The company injected $2 million of capital, including big investments from the management team and the board, specifically for marketing.
And they're doubling ad spend.
Doubling it to $500,000 per quarter. And they plan to keep it at that level all through 2026.
That is a hefty spend for a company this size. And that brings us right to the financial gating factor, that thin cash cushion.
The financial risk is paramount. I mean, despite that capital injection, their cash on the balance sheet is only $1.6 million.
That's not a lot.
It's not. Now, their debt is minimal, only around $326,000. But with continued losses and that aggressive $500,000 quarterly marketing spend, converting that bigger pipeline into actual cash is absolutely non-negotiable.
If they miss, or if that legacy drag lasts longer than they think, that $1.6 million disappears fast. And then you're looking at a dilutive capital raise.
The clock is ticking. And that's what the market is anchored on. It's a classic divergence. Management is focused on product velocity. The market is focused on the cash balance.
But they do have some serious macro tailwinds helping them out.
They do. Their core market is being pulled forward by the insane complexity of B2B e-commerce catalogs, and also by rising buyer expectations for AI-assisted search.
So those tailwinds should help make that 92-day sales cycle the norm.
They should. The key checkpoint for everyone is going to be the Q1 26 earnings call, probably in February 2026. That's the first real read on pipeline conversion and whether those new partnerships are paying off.
All right, let's put it all together. Standard disclaimer. This is absolutely not financial advice. We're talking about a microcap with low liquidity. This is highly binary and very risky.
Extremely high risk, extremely high reward.
Okay, so given the strong operational data, we're going to pitch an outrageous but plausible trade idea. We're calling it the February Catalyst Conversion Play.
The thesis being a long position on the stock, BLIN.
Exactly. Go long now, accepting that near-term cash risk. The bet is that the combination of the 92-day sales cycle, the bigger deal sizes, and the new partnerships will allow the Q1 results in February to prove the pipeline is converting.
So what's the trigger? What does the market need to see on that call to re-rate the stock?
The trigger is material subscription ARR acceleration. Specifically, if the company can show that the $500,000 quarterly ad spend is already yielding positive cash conversion.
Meaning they're acquiring new ARR quickly and profitably.
Right. If they can show that, the market will have no choice but to stop staring at the $1.6 million cash balance. They'll have to re-rate this as a specialized, high NRR SaaS player, which justifies a much higher valuation.
The risk is very real. That cash position is tight. But the operational metrics, the 117% NRR, the 92-day sales cycle, they suggest the core business is working beautifully.
It's a bet on speed of execution, mitigating financial vulnerability. So to recap, Bridgeline is successfully transforming into a high-efficiency, AI-first B2B search vendor. They've got the product and the velocity. The battle is purely financial. Can they execute on that big pipeline before the cash runs low?
And that leads to a really provocative thought that the CEO mentioned on the call. It speaks to the future of the whole sector.
What was that?
He talked about the market moving toward, and I'm quoting here, selling to agents rather than people.
Selling to agents, what does that even mean for a company's valuation?
Well, think about it. If sophisticated AI agents become the main purchasers in B2B, automatically sourcing and negotiating contracts based on pure data, it completely bypasses the traditional sales process.
It takes the human relationship part out of it.
Completely. If AI agents are doing the buying, does a 92-day sales cycle suddenly become the new maximum for an enterprise sale? And if it does that just dramatically reset what durable SaaS growth looks like? It shifts the whole game from relationship building to pure product capability.
That is a fantastic point to end on. The disruption they're chasing internally might be a transformation facing the entire B2B world. Thank you for guiding us through this one.
My pleasure.
We hope you feel thoroughly informed on the story behind the numbers. Until our next deep dive, be well.